Hey everyone, Longacres Finance here, and it's time to check in on how the Dividend Aristocrats are doing this year. Let's start off with the return for the Dividend Aristocrat ETF, ticker symbol NOBL. The year-to-date return for NOBL through month-end April is 13.22%. That is a phenomenal return for this investing approach, after only 4 months into the year. Matter of fact, this is the second best start to the year NOBL has had since the fund launched in late 2013. The only better January to April period for this ETF occurred in 2019. The fund was up 13.84% versus the 13.22% this year. The annual return this year is so far the fourth best annual return in the fund's history, behind 2019 when the fund had its best year with a return of 26.94%, and 2017 when the fund gained 21.03%, and 2014 with a return of 15.54%. But we are only through 4 months in 2021, and the fund still has plenty of time to catch up and surpass those excellent years. Historically, May has been a pretty decent month for the Dividend Aristocrats, with 6 of the last 7 years seeing positive returns, and the fund being up 0.74% on average. The last few days in the market may not feel like we are in for a decent month, but we still have a few weeks to go. The NOBL ETF holds positions in all 65 of the current Dividend Aristocrats, and since these individual stocks are always moving up and down in price, it is impossible for the fund to be equally weighted to each stock. An equal weight approach, theoretically, because it would be impossible to achieve, would have generated a higher return than the fund has. An equal weight approach would have bested the fund each month except March, and on a year-to-date basis by about 0.5%. Taking a look at the individual holdings, Nucor Corporation currently has the best year-to-date return of 55.43%. This is primarily driven by the rise in price of steel, which Nucor happens to manufacture. People's United Financial is pretty close behind Nucor with a 43.51% return. And Exxon also has a very nice year-to-date return of 41.26%. The worst performing Dividend Aristocrat this year is Clorox, which is down 8.63%. McCormick & Company also had a rough start to the year, losing 5.11%. And Colgate-Palmolive wraps up the bottom 3 with a loss of 4.57%. Only one Aristocrat has beaten the NOBL ETF each month this year, and that stock is General Dynamics with a year-to-date return of 29.58%. Let's say hypothetically you were able to pick the best Dividend Aristocrat each month. What kind of return might that have gotten? If you picked Walgreens in January, you'd get a 26% return for that month. Then if you picked People's United Financial in February, you'd get a 31.33% return for that month. Then if you jumped over to Nucor in March, it would have earned you 34.86% during the month. And in April, if you had picked up West Pharmaceuticals, that would have gotten you an additional 16.65%. Those 4 returns combined would leave you up 160.32% for the year. Not only crushing the NOBL ETF and all broad market indices, but probably the vast majority of individual stocks. Of course, it's not easy figuring out which stock will have the best return each month, even in this smaller sample of 65 stocks. The probability of randomly choosing this combination is a 1 in 17.8 million chance. The same odds apply for selecting the worst combination of monthly returns, which would have lost 32.72% over the past 4 months. Most individual investors who pick individual stocks don't do it randomly, but rather through research or by following a strategy, which is what you should do. Let's see how some methods of selecting Dividend Aristocrats are faring this year. If you opted to invest in the 10 highest yielding Dividend Aristocrats at the beginning of the year, you would have chosen the following stocks: Exxon, AT&T, Chevron, People's United Financial, Federal Realty Trust, AbbVie, Walgreens, Realty Income, Franklin Resources, and Consolidated Edison. And through April, your year-to-date return would be 23.89%. So thus far, the highest yielding stocks are crushing the overall Dividend Aristocrat index. Not to mention the dividend income from these 10 stocks is far greater than that from NOBL. If you instead invested in the 10 Dividend Aristocrats that are growing their dividends at the fastest rate, you would have chosen the following stocks: AbbVie, A.O. Smith Corporation, Franklin Resources, Cintas, Illinois Toolworks, Lowe's, Roper Technologies, Sherwin-Williams, S&P Global, and Cisco. And through April, your return would be 13.73%. So just slightly better than the NOBL ETF, and much worse than the highest yielding stocks we just looked at. If instead you chose to invest in the 10 Dividend Aristocrats with the smallest dividend yield, not sure why one would do this, unless you love dividend stocks but hate receiving large dividend payments. Either way, with the smallest dividend yield approach, you would have chosen the following stocks: Roper Technologies, Sherwin-Williams, S&P Global, Ecolab, Brown-Forman, Cintas, Albemarle, Expeditors International of Washington, West Pharmaceuticals, Becton Dickinson and Company. And through April, your year-to-date return would be 7.85%. So this approach is grossly underperforming the Dividend Aristocrats as a whole at the moment, and also paying a significantly lower dividend yield. Option number 4 would be a momentum play. If you invested in the 10 Dividend Aristocrats with the best return in 2020, counting on that strong performance to continue. FYI, this isn't how a momentum factor tilt works, I just borrowed the name. With the momentum approach, you would have chosen the following stocks: Albemarle, Target, Lowe's, Cintas, Clorox, Sherwin-Williams, Abbott Labs, Colgate-Palmolive, T. Rowe Price, and AbbVie. And through April, your year-to-date return would be 8.81%. So this approach is also doing pretty poorly compared to NOBL and the other strategies we looked at. And finally, option number 5 is to invest in the most undervalued stocks based on dividend yield theory. If you invested in the 10 Dividend Aristocrats that were the most undervalued at the beginning of the year, you would have chosen the following stocks: Amcor, Atmos Energy, Becton Dickinson & Company, Chevron, Consolidated Edison, General Dynamics, Hormel, Linde, Walgreens, and Exxon. And through April, your year-to-date return would be 15.64%. Although this return is not quite as good as the high-yield approach, it is more than 2% better than the NOBL ETF return. I'm not advocating for any of these investing approaches, because correlation doesn't always mean causation. That basically means that just because two things are correlated, it doesn't mean that one is causing the other. So in layman's terms, if you look hard enough for a pattern in investing, you'll always find one. But that doesn't mean it'll continue to be a pattern in the future. If you guys know of any other interesting approach to selecting individual Dividend Aristocrats, let me know in the comments below, and I may include it in my future analysis. That's it, thank you for watching, and see you next time.